Welcome back to the Bell Potter Emerging Leaders Conference for 2023. We're kicking off the afternoon session with a very topical company, one that is sitting on one of the most significant discoveries ever made in Australia, Chalice Mining. Its flagship asset is its 100% owned, half-billion-tonne Gonneville nickel-copper PGE project in WA. Gonneville is a long-life, low-cost asset which also carries value as a globally significant, strategically valuable, palladium-dominant critical minerals project. However, not everyone in the market saw it that way upon the release of a long-awaited scoping study on the project. It contemplated two development scenarios: a 15 million tonne per annum $1.6 billion project and a 30 million tonne per annum $2.3 billion project. To run us through the details and the development outlook, it's my pleasure to introduce Managing Director and CEO, Alex Dorsh. Welcome, Alex.
Thanks, Dave. Good to be with you. Good afternoon, everyone. As Dave said, I'll give an update on Chalice and our Gonneville nickel copper PGE project here in WA. So thanks everyone for joining. Our usual cautionary statements, competent purposes disclosures, these are available to read in full on the ASX platform or on our website. So Chalice is an ASX 200 explorer developer. We're focused on, as Dave said, our flagship Gonneville project. It's a major new green metals resource here in WA, but also has dual focus on the West Yilgarn province, which surrounds that project. It's a very unexplored province, and we think it will play a major role in defining a new industry and a new frontier for these metals in Western Australia. Whilst it has been a little bit disappointing to see the share price reaction to the initial study for our flagship Gonneville project, I guess what has been very pleasing has been some of our long-term shareholders increasing their stakes substantially. So Tim Goyder, the founder of the company, has increased over 10%, as well as BlackRock, obviously the mining fund there based in the UK, has further increased their substantial position. The company is very well funded. We've ended June with 145 million Australian dollars. And obviously we remain focused on really now, I guess, getting into the more detailed engineering and studies for our project, but also the regional exploration surrounding that deposit. So as people would have seen in the scoping study, really Gonneville is really outlined to be a long life, low cost, low carbon green metals project in WA, and a very, very sizable one. So it's a strategic sized project. And that really, in being in Western Australia, means that it could really attract a significant Western and green premium in the market, not only for its products, but obviously in its valuation as well. It's scoped to have world-class sustainability metrics, obviously very important. It's low carbon intensity. It's obviously going to be IRA compliant metals, and it's going to contribute about $18 billion to the WA economy. And more importantly, I guess, to the local economy and the region surrounding. It's an executable tier 1 scale development project. We've scoped 2 open pit cases for now. We haven't included any underground mining options as yet, but obviously the resource here extends well beyond the open pit plans that we've outlined. And so as you can see, there are 2 different cases, 15 and 30 million tonne per annum, which just reflect the optionality inherent here in this deposit. So a substantial quantity of PGEs to be produced from this asset, but also a substantial quantity of nickel, copper and cobalt as well over an 18+ year modelled life. And obviously we're anticipating significant extensions to that model life over time, just given that there's so much resource beyond the limits of those pits, as I mentioned. The project's going to have a compelling returns, competitive cost profile. I guess one of the most important metrics of the study was that position in the second quartile of the cost curve. So cash costs of US $160 to $230 an ounce, and generating between 6.6 and 9.9 billion Australian dollars of free cash, and with a very short payback of 2 years. So importantly now, it is an early stage study, but there is a strong upside and a lot of development options that we need to work through. I mentioned that we haven't incorporated any underground mining as yet. That is a priority for the coming months. And obviously the resource is still getting drilled out, still being expanded. the optimal flow sheet and really sort of those mechanisms to get product to market are still very much getting defined. In terms of the metrics, I should mention tier 1 scale production profile, highly competitive financial metrics, but these are with limited really engineering or optimization applied to the project at this stage. So very much indicative directional sort of numbers. Low strip ratio of 1.8 over the average, pre-production capex of 1.6 to 2.3 billion, depending on the scale that we deploy. Obviously, there are options as well to start with smaller throughput and stage that capex over a longer period. But I guess we foresee this asset eventually getting to that scale range between 15 and 30 million tonnes per annum. I mentioned the cash costs, obviously very important. EBITDA levels between 670 and 1.1 billion per year, which would make it one of the largest, I guess, assets of its kind in the country. Free cash flow after tax, obviously very attractive numbers there, particularly in the first 4 years, where you've got the benefit of some very high grade near surface. NPV, obviously at this stage, NPV is not particularly meaningful given that it's only a scoping study, but between 2.8 and 4.2 billion on our assumptions. IRR of 26%, 2-year payback period, and a healthy premium, I guess, of NPV over pre-production capex of 1.8 times in both cases. So both of the cases are positioned very, very attractively on the PGE industry cost curve. So there's a couple of things to note here on this supply curve, or this net total cash costs per 40 ounce PGE industry cost curve. So the first point to note is that Norilsk occupies a significant portion of the PGE industry supply curve. They've got negative cash costs due to their high levels of base metal byproduct credits, but as we all are familiar with, Russia has significant challenges at the moment, politically, but also, stability, operational stability and sustainability wise as well. We expect Gonville will be the next best, I guess, producer in the PG industry, as it says there, between 170 and 240 US an ounce, based on 2022 actual prices. And then I guess on the right-hand side here, you see predominantly Southern African mines. Really that's where most of the remainder of the PG metals come from, is mines in South Africa and Zimbabwe. And those costs in those countries, as it says there, they're rising something like 10% year on year relative to 2022 in nominal terms. So as you can see there, the cash costs for the fourth quartile currently sit at the sort of estimate of the spot basket price at the moment, around $1,250 to $1,300 US an ounce, but all in sustaining costs for that fourth quartile average about $1,500 US dollars an ounce. So I guess that we're flagging here that our expectations is that unless the supply curve contracts significantly, believing a sustainable price lower than US 1,500 per ounce is just not particularly realistic in this context, and given the context of the inflationary pressures and supply and operational challenges in particularly South Africa. So the scale, the quality, the location of the resource really underlie its cash flow potential. As you can see there, the first 4 years particularly meaningful, and then I guess a 2-year expansionary period factored in years 4 and 5, eventually leading to that 6.6 to 9.9 billion of total free cash. That ignores any residual value beyond the open pit, as I mentioned. You can see that predominantly it's about a 60% PGE revenue stream on those long-term price assumptions, and about 40% from base metals. So base metals still a very much important part of the asset and its profitability. In terms of the resource, obviously this is a schematic looking along the strike length of the resource. You can see the resource is now very well drilled in that sort of first 400 to 600 meters below surface, but then it's very poorly drilled, beyond that levels. And we know though that the mineralization here at this deposit extend well beyond those depths. So we've intersected some very, very attractive, zones of mineralization there down at a depth of about 1,200 meters below surface. So I guess we are anticipating that ultimately this will progress from an open pit scenario into an underground scenario. Potentially also, I guess what's more interesting is, bringing some of that grade forward in the mine plan as well. So doing a combination of open pit mining and underground mining. You can see there as well that Gonville intrusion is projected to extend a further 1.6 kilometres below the extent of the lowest resource block there on that page. So there's a material opportunity here to really grow the resource, but also bring that high grade forward. And that's a twofold benefit, really, because not only do we get the benefit of higher grade and higher metal per tonne process, but we also know that flotation recoveries are obviously significantly higher for higher grade material and higher grade blocks relative to the lower grade material or that open pit average. So there is a spectrum of recoveries according to grade here in this type of deposit, and I'll speak to that more in the coming slides. So really sort of honing in on now, where are our near-term priorities as a company, to really, gauge the upside here and really capture, those value opportunities. I guess from a mining perspective, I mentioned the early underground opportunities. That is a priority for us at the moment to really define those. And then we're doing a significant amount of drilling to really model up what the sort of the potential is at depth in terms of those higher grade underground scenarios. And then secondly, on geomet domaining, we have some variability in parts of this deposit that we need to explain more thoroughly with domaining of the deposit into several sort of subsets. And then I think that one of the key things going forward is really we've done most of our flotation work on a sequential copper and nickel flotation process. That has the benefit of being able to separate the copper away and sell the copper and most of the PGEs to a copper smelter. But we're also looking at, I guess, a more of a recovery maximisation strategy and just pushing all the metals into a singular bulk con, and then either selling that bulk con directly to a smelter or doing hydromet essentially on the entirety of that product. So I think that's where really there's a lot of work to be done to really work out what is that optimal pathway. And just given the complexity of we're dealing with a polymetallic nature of the deposit, different sort of mechanisms to sell those products. Obviously, there's lots of work to do there to work out that strategy. Like I said, obviously, we're in the middle of a strategic partnering process. That is ongoing. Really, we're aiming to bring in technical and financial capabilities to the asset. That goes without saying. An asset of this size is there's well and truly room here for multiple strategic partners. And then we're also, really advocating to government strongly around, deliberate and pointed formal government support for an asset of this scale and this nature, given the importance of these critical metals and the scarcity of the deposits like this in the Western world. So specifically on the flow sheet, as most people will be aware, we've, I guess, progressed the oxide materials planned to be, processed using a leach to recover the palladium and gold in that material. I guess there's still a question mark on exactly when that oxide material is processed and when that leach plant is constructed. I guess the priority remains getting the sulfide feed and the sulfide flotation parameters really optimized in the near term. So like I mentioned, at the moment, we're separating a copper concentrate from the nickel iron concentrate. There's potential to just combine those two and then put the entirety of the feed into one bulk concentrate. And that really, I guess, is where we see the meaningful upside to the recoveries as stated. So lots of really, I guess, parameters here to work with as we move into a PFS. And then zooming back from, I guess, the Gonville project down the bottom left here, I guess, there is a reminder here to everyone really that this is much larger project than really what we've got just on farmland at Gonville here. We've got a 30-kilometre belt of mafic, ultramafic rocks. Really, I guess the priorities going forward is, following up some of the results we had at the Hooley Dampier strike length here, about 5 kilometres away from Gonville. We're going to be recommencing drilling shortly, later this quarter, in that area. And then I think most important is really testing the Bodan, Jans and Torres targets for the first time. That's going to be likewise commencing this quarter, subject to getting the final approvals we were expecting from government. And really, there's some very attractive, coincident nickel copper responses here in soils that also, need an initial diamond hole really to gauge, their full potential. So there's a lot exploration work to do here. It goes without saying that this is a substantial geological feature and obviously a big part of the West Yilgarn effort. Looking at that sort of section between Gonville and Dampier there, that this is about 10 kilometres of strike length there that we're looking at. You can see some of the very encouraging intersections we had recently at Hooley. These are basically identical geology, identical mineralisation to what we've seen at Gonville. So we expect that ultimately we will join up these parts of the complex into one continuous piece. And that, really, I guess, highlights the level of upside here beyond, what we're talking about just in terms of open pit material over on the right-hand side of the page there. Lots of work to do, I guess, to determine really where are the high grade, I guess, targets within this space, as well as test, there's 3.5 kilometres here between Hooley and Hartog that as yet we haven't been able to access, but we will be able to get access to later this quarter, as I mentioned. And then zooming back, I guess, to the West Yilgarn, obviously Gonville is just the first discovery in this belt and in this province. It is almost completely unexplored and a misunderstood part of Western Australia. Obviously, between 1965 and 2020, there's been about 25 million tonnes of contained nickel discovered in the Kalgoorlie-Canalpi province. So it is really a multi-decade sort of type of effort to define that level of full potential of a province. And really, we've discovered about 0.9 million tonnes of nickel to date on the western side of the Yilgarn. We think there's likewise here a multi-decade generational type opportunity to replicate that success in the eastern part of the Yilgarn over on the western side. And we know that the western side of the Yilgarn is a favourable position for world-class, orthomagmatic systems. These giant type nickel copper PG systems typically do reside very, very close to these craton margins, obviously, and the western edge of the Yilgarn is just really completely unexplored as yet for these types of opportunities. So we're in the driver's seat very much. We shortly after the discovery staked 8,000 square kilometres of licences. We've now expanded that through a number of earning joint ventures to about 9,500 square kilometres, as you can see in those orange areas along that western side of the Yilgarn. So I guess very exciting. Towards the end of this year, we will be drilling, really executing on a couple of years worth of early stage targeting work that we've done through the West Yilgarn over the last couple of years has now resulted in a number of greenfield, drill-ready targets that they're going to be drilled this financial year. So starting in November, December, depending on cropping timing, we will be going around and drilling, like I said, there are at least 10, completely wildcat type targets. And really, we know this province can deliver, semi-massive, massive sulfides, that are obviously very, very high tenor. Gonville discovery hole was a great example of that. So really, that is the prize. We know that mineralisation, which graded 3% nickel, 1.2% copper, 10 grams per tonne PGEs, was very, very close to surface. So I guess that's really the prize, is finding more, Gonville-like signatures like that. And obviously we've got proprietary knowledge and know-how as to how to do that. So a very exciting period coming up in terms of the regional exploration program. And then I guess alongside that, a number of other milestones ahead for Gonville around strategic partnering, like I mentioned. I guess PFS, we've formally commenced our PFS now, targeting mid-2025 for delivery of that study. That's going to be looking at the underground mining, and obviously we're drilling out a large area of underground potential at the moment with a number of rigs. And really, I guess, alongside that, really working on that flow sheet to determine sort of where the optimal, scenario lies and where their optimal product mix is. We're going to be commencing our regulatory approvals process early next year. So that, I guess, was part of the rationale for scoping the cases we've scoped, as well as that we need to get obviously those parameters, to the regulator and really kick off that process. And then I guess later in 2024, we envisage, we're starting to be having some offtake and financing discussions with parties. And obviously there's a strong level of interest and I guess a wide, acknowledgement about how many projects like Gonville need to get up in order to achieve, the world's decarbonisation goals. So we remain very confident that we will have funding solutions available to fund a project like ours. So I guess to summarise, we've got 100% control of a new long life, low cost, low carbon green metals project in WA. It is a very, very unique project, perhaps a little bit misunderstood by the market. It is in the early stage of studies. So there's a lot of work to do to really engineer it now and sort of work out where those value opportunities lie. We've got the team, we've got the track record of really, finding more of these things, but also really, working out those optimal, value creation mechanisms in studies. And like I said, there's significant exploration upside here across this province. And whilst the market is very focused on Gonville and just Gonville at the moment, we should not forget that, there is a almost 10,000 square kilometre land holding around this asset that is very much, very prospective for other, nickel sulfides and other orthomagmatic types of discoveries. So on that note, Dave, I might pause and go for some questions.
Great, thanks very much, Alex. Appreciate that very comprehensive run through. So look, you've had a bit of time to digest the market's reaction to the scoping study and get a feel for the pushback. What have been the key issues that have come back to you guys?
Look, I think that first and foremost, there was, I guess, a disagreement, I guess, with the market around long-term PGE prices in particular. I guess, we've informed our views based on the advice we've got from an independent forecaster, AME, and they absolutely stand by their long-term price assumptions. And obviously, here we're trying to work out long-term prices over a period like 2029 to 2050, pretty much. So it's very hard to get an average over it's very hard to forecast, over the long term like that. But I guess the assumptions that we've seen AME use, we think are very robust, and we agree with them. And then I think I think you just need to look at the supply dynamics of PGs. Like I outlined there, just need to look at the cost curve to see that where the sustainable sort of basket price levels lie for the industry. So unless you believe there's going to be a major decrease in demand for PGEs, which funnily enough no one really forecasts a significant drop in PGE demand because of hybrid uptake and the role that hybrids need to play alongside fully electric vehicles. And the other point is, I guess, that demand we expect to remain strong because the emissions reductions and emissions standards continue to tighten. So that really necessitates higher and higher PGE loadings per vehicle and per internal combustion engine and hybrid. So I guess that's one of the main criticisms that we've received from the market is I guess we're out of step with the consensus, but we're very comfortable, I guess, with the assumptions we've made, and we think will be proven right, and we're going ahead, I guess, progressing to an FID on that basis. We're also, I guess, we had some criticism about the lack of, I guess, smaller options being scoped. Just to be clear, we haven't not done work on those smaller cases. We just hadn't, I guess, as the resource grew bigger and bigger, and as I guess we've monitored the dynamics on the PGE industry over the last few years, we've become, I guess, very strong in our conviction about this ultimately becoming a very large scale open pit type of operation. But there are lots of ways to do it, and there's lots of ways to get to that 15 to 30 million tonne per annum scenario. So we're working on those at the moment.
Yeah, well, like you say, pretty hard. It's hard enough predicting prices next year, let alone from 2029 to 2050. But then on the flip side of that, as you mentioned, I've seen a number of increases in substantials lodged over the last few days, and we've certainly, picked up some positive feedback as well. What would be the flip side to that? What are the positives that have come back from the market? What are the strengths they're seeing in the asset?
Look, I think we've had a number of long-term investors come to us and express their support for what the company's done, what the study shows, I guess the robustness of the work. There's always going to be disagreements about forecasts. We all know forecasts are going to be wrong. So yeah, it's been great to see Tim and BlackRock, as well as other long-term holders, really sort of step in and acquire more shares. That's obviously been great, and we're very fortunate to have those long-term believers very much embedded in Chalice. So I guess, yeah, we try to block out the noise around the short-termism in the market, very much so. I think that's not a productive, thing for us to be reacting to short-term and sort of spot price environments or thinking around spot price environments. So we remain focused, like I said, on really delivering now a much more detailed sort of study, as well as sort of executing on those upside opportunities, like I mentioned, around underground mining, really improving the recoveries and optimizing that flow sheet. But also, like I said, securing strategic partnerships, in the asset.
And just on that, Alex, I've got a couple of questions online and one for myself around those opportunities. Are the what do you've run through what you see the key opportunities as being, underground and optimizing the flow sheet, potential for bulk concentrate. But how would you could you are you able to give an indication of what sort of the cash flow leverage is on some of those grade improvements or recoveries, improvements in recoveries? Do you have a sense of
Yeah,
what
look, I think
that would sort of broadly look like?
we haven't quantified that yet, and look, yeah, we are aiming to do that, in the near term. Really sort of quantify more clearly what that grade recovery relationship is for each metal. Obviously, at this level of test work and this level of sort of understanding at a scoping study level, we've taken a very averaged view across the deposit, but there are more nuances in certain areas of the deposit. We expect better recoveries. In certain other areas of the deposit, we expect worse. So I guess that exploring that and getting very precise on that grade recovery relationship is obviously a critical piece of work. We haven't really done, like I said, any engineering yet. So I guess the scoping study is just purely a directional type of answer in relation to the flow sheet and the recoveries. Like I said, I think you just have to look around the resources industry to see how big projects like ours change, typically very, very dramatically between scoping study and an FID or a DFS. So I guess we're really sort of needing to do the work, continue the test work, continuing those sort of engineering trade-off type option analysis, and as well, I guess work out which parts of that flow sheet really need to be built up front and which ones can be deferred over time. That's I guess another critical piece of work that we really haven't had a go at yet. We've sort of assumed that the entirety of the flow sheet is built up front, and obviously that's the basis of the capital cost estimate. There's lots of ways we can stage that and go up in build sort of multiples of modules in smaller sizes to reflect ultimately sort of where that how that feed grade and that ultimate sort of mine plan looks like. But I guess there's lots of parameters there that you only need to move a very, very small amount, and a cumulative can have a very, very big impact on cash flow generation for an asset of this scale. And that I think is you see time and time again on assets like ours is these are tier one assets. These are sensitive to the inputs. So I guess at a scoping study you don't really spend too much time massaging before you really I guess get some more confidence around those inputs and get some more accuracy around them, and that's what we intend to do.
Yeah, and the scoping study presumably is a key input into the strategic partnering process that you're currently running. What can you give us an update on the timing and perhaps the number and nature of partners that are in the process at the moment?
Yeah, so we've got a broad range of interest from all sort of sides of the industry at the moment. Obviously the data underlying the scoping study was provided to parties a number of months ago. So we've been working with those parties, sort of engaging on sort of their thoughts around the scale as well as the optimal sort of pathways. There has been, I guess, a lot of discussions around it. It is an early stage study, so it's hard to get definitive around sort of where that optimal solution lies. But like I said, there's lots of input at the moment from a broad range of parties, and we're very much continuing with that process now. Difficult to guide exactly as to when we will have an update to the market around that, because I guess it's very much ongoing. But we'll try to obviously keep the market informed as best as we can as we progress into the next phase.
Yeah, no, completely understood. All right, Alex. So that pretty much brings us to time. So look, thanks so much for taking the time to present to us today. It still presents as a very exciting story. We're ticking a lot of boxes for a globally strategic asset. We certainly continue to see the value in it. But yeah, thanks again for taking the time to tell us the story, Alex.
Pleasure, Dave. Yeah, thanks everyone.